Hello, everybody. Welcome to another edition of your Daily Five. My name is Chris Kimble, and today's May the 10th. And this is my 42nd year in the business. And when times are getting, as they are, very volatile, I want to talk about what I've experienced in 40 some years is what are the best tools when volatility is pretty crazy. If you're below a moving average, that doesn't give you a buy point. You're just below it, right? So, and then say 2000 to 2003, relative strength stayed low for years. And yet the market and tech, we know, declined 90% during that time frame. So I want to talk about a lot about Fibonacci today, and that's why I'm showing these repeating patterns, all over. We're all aware from in nature and the galaxy and weather and different things. So I want to talk about how the market turns week right at Fibonacci extension levels, the performance since last month's show, another look at 90-year Fib levels, how I feel the S&P is testing important support right now. We're going to look at Fibonacci levels on the Nasdaq. We're also going to do that in interest rates. So we're going to have a lot of fun with Uncle Fibonacci today. So this was a chart that we showed essentially a month ago right now. And it was that we applied Fibonacci to the 2007 and 2007 highs, 2009 lows, and that the 423 extension level was coming into play. And with valuations where it is and an extension level, to me, it's just a recipe for what's been going on. And so we've been trying to let people know for months that this is not a risk on time frame. And we're going to discuss where we can try to find entry points from a Fibonacci perspective. So again, this was last month, not a surprise that it happened. We've been banging the drum for months after months. We've shared that if you only had one chart on the planet, it'd be the AD line. If I was on a deserted island, and this just shows that in 2007, we had a bearish divergence. And if people missed this very bearish divergence, I'm not sure why. And even if you look down here in the S&P, you see that could even be a potentially topping pattern as you see this negative divergence going on. So I don't think some of these things should be so surprising that are taking place. So here's the performance from last month's show. You can see TLT, and this is just a 30-day performance, everybody. This isn't an annual thing. It's just 30 days. Bonds are down 800 basis points. The S&P is off over 1,000 basis points, off 11%, and tech is almost off 1,500 basis points. So are opportunities at hand? I think here's one opportunity that one of the things that I love about StockCharts is the ability to try to use moving averages as tools for extremes. Instead of trying to use it as a tool, are we above or below moving averages? How about trying to use it as long-term extremes? And so this chart goes back 60 years, and it's looking at the yield on the 10-year note. And you can see it's in a long-term downtrend. We all know that interest rates peaked in 42 years ago. So now interest rates are testing the top of this falling channel, and they're 72% above their 2-year moving average. And the closest occurrence to that was about half of this. And that was at the yield high in 2019 prior to the COVID collapse in interest rates. So this is a huge opportunity, in my opinion, from extremes. We want to then convert that to Fibonacci now. We're going to go back to the 1994 high and 10-year yields. We're going to take the monthly closing high in Fibonacci. We're going to take the monthly closing low in 2020. And the 38% retracement level comes in at 332. And so we're just underneath that. And you also see a falling resistance line. So we've got an extreme move. Nobody likes bonds, understandably. What is all of the talk about inflation? And yet I can't understand that if most people own a 60-40 portfolio, we have now witnessed the greatest deflationary time to start off a year in history. So as Powell's concerned about inflation, I think most investors are concerned about their portfolio deflating. And so if stocks continue to deflate, there's the odds increases is where yields peak. We shared several times, and this is from a month ago, that I thought this was really strange that if you took 1932 low in Fibonacci and the 2007 monthly closing high, it came into play at the exact same price as if you applied Fibonacci to the monthly closing high in 2007 and 9. And why should it be a surprise then if some reversals take place at that. So here's the update on the chart. And so this is the one, as Will Smith would say, that'd be a real slap in the face to the bull case if selling started at these Fibonacci levels. And it has, folks. So I really, again, think that you may be a trader, but the old saying, when in doubt, look out, and look way out, get way out of the things and start applying long-term fib levels in times of panic. And I think it's really going to help you. The S&P really needs to hold here, folks. This is a 10-year rising channel. I applied the Fibonacci, to the 2007 highs, 2009 lows. We're at the 161 level as weekly momentum is oversold. To me, this is a make or break price point with the S&P. If it can't hold here and somebody says, oh, this is a head and shoulder top and that's the neckline. If it doesn't hold here, despite being oversold, you could see a pretty large sell-off. One of our targets from a Fibonacci perspective is what I want to call 38 at 38. We took the 2020 lows of COVID, the 2022 highs, and you can see that the 23% retracement level was support, but now we've taken that out. So one of the entry points that we're looking at will be the 3,800 level in the S&P, which is the 38% retracement level. So it's kind of odd how those two matched up, and just FYI, the 50% retracement level comes in at 3,400. Taking Fibonacci again, let's take Fibonacci and apply it on the Nasdaq to the 2000.com highs, the 2003 lows after a 90% retracement. Apply Fibonacci. Should it be a surprise, everybody, that it peaks out? It appears to peak at the 423 extension level, and then this is its 2-year moving average. And so this is the first time since the financial crisis that it's closed below, on a monthly basis, below its 2-year moving average. Big support test. I'm going to be interested in tech if it reaches, and the NDX is at 10,000. We talked about this chart again in a prior take 5, is that the Hang Seng Index was breaking this extremely long-term almost a 30-some year support level. And so if this breaks, that's bad for some small country, called China. And so I wanted to update. Weaknesses continued there. I have a bias. We've owned FXP for a while. That's the double short Hang Seng. And so now let's apply Fibonacci to the Hang Seng. Let's go back to the 1970s and let's apply it to the 2018 highs. And guess what? The 50% retracement level comes in at 17,500. So this is going to be a point that we're going to look at closing the short trade and looking at entering a long. We talked about this last month, that this is a semiconductor S&P ratio. I think this is leadership. And if we see leadership break down at this Fibonacci level, this is a huge key for the semiconductor index. And it's happening, folks. Despite the shortages around the world, this is not good from a leadership perspective. And so here's, I'm going to try to finish up on this long-term chart on the Dow quarterly. And this reflects that I like finding the channels by first finding lows to try to find highs. So we took the 1942 low and the 1982 low, and then did a parallel copy paste, and lo and behold, the market hit the top of this channel, as quarterly momentum is one of the most overbought. So this is a place that the bulls do not want to see selling get started. So thank you again for the time today on another edition of your Daily 5. I think this is one of the most opportunistic times in my 42-year career here. You got to play it right. Use Uncle Fibonacci as your friend. If you want to continue to see how we do this, we're offering a large discount on our research, and you can find it by going to Kimble, chartingsolutions.com/StockCharts. Thanks again, everybody, and look forward to seeing you next month. Take care.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.